The media is still talking about the silver bubble and how the silver bubble popped, and it was crazy that silver went to 121. Look, it was a bit crazy how quickly it went to 121. But what's even crazier is that it took that many years to get to 121. It should have been there earlier, and it will be there again. It will be there a lot sooner than people think. Silver prices still below $80. Hard to imagine. I'm now saying that it's cheap to buy silver below 80, but it's been as high as 120. So seems pretty cheap given that we now have a benchmark that's much higher. So we're buying silver below 80 and $5,000 gold. 5,000 is the new 4,000. 4,000 was the new 3,000, which was the new 2,000, right? The milestones keep moving up, but you got to keep paying up because this is what happens when you're living in a world of inflation and de-dollarization. The longer you wait to get rid of your dollars, the less they're going to be worth, and the higher the price you're going to see for gold and silver.
The mainstream media's characterization of the recent silver correction as a popped bubble fundamentally misinterprets the market, ignoring that the surge to $121 was a long overdue repricing rather than speculative mania. While the rapid ascent stunned observers, the real anomaly was that it took so many years for the metal to reflect the underlying monetary expansion. With prices currently sitting below $80, the market is offering a rare discount against a proven benchmark, suggesting that the inevitable return to triple digits will occur far sooner than the bearish consensus expects. Peter Schiff, chief economist at Euro-Pacific Asset Management, argues that these rising milestones are merely symptoms of systemic currency devaluation. Just as gold has normalized $5,000 as the new support level, replacing previous floors of $4,000 and $3,000, investors are witnessing the direct effects of inflation and global de-dollarization. The milestones for precious metals will continue to rise because the dollar's purchasing power is in a permanent state of decline. Schiff warns that hesitation is costly. The longer one waits to exchange depreciating dollars for physical metal, the less real value they will ultimately be able to secure. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The media is still talking about the silver bubble and how the silver bubble popped, and it was crazy that silver went to 121. Look, it was a bit crazy how quickly it went to 121, but what's even crazier is that it took that many years to get to 121. It should have been there earlier, and it will be there again. It will be there a lot sooner than people think. But the media, again, is trying to scare people out of gold, trying to scare people out of silver. Meanwhile, I think what's going to happen before we hit a new high in gold or silver, I think we're going to hit a new high in gold and silver mining stock. They were up nicely today, about 5.5%, 6%, but they're still way off their highs. But given that gold and silver are still way off their highs, silver is what? Got to be like 20% off. Gold's still about 10% off its highs. I think as they make new highs, the mining stocks will make new highs first, because I think one of the reasons that investors were so reluctant to buy the miners is they were worried about a big drop in the price of gold or silver because they kept rising. Well, now we've already had the big drop, right? It's now behind us. And so I think people ultimately won't be afraid of another drop when the drop already happened. And I think we'll have a bit of a slower rise this time that'll be more sustainable. And I think that will, give a good opportunity for the mining stocks to get some real traction. So people who are interested in getting involved in those should definitely do so, and should check out the separately managed accounts at Euro-Pacific Asset Management, and also check out our gold fund. EPGIX is the symbol for the gold fund. But the opposite is happening in Bitcoin. Bitcoin is in a major bear market. In fact, at its low yesterday, Bitcoin traded below 60,000. That was better than a 50% decline from its record high of 126,000. Now, today, Bitcoin was up 10%, and it's back just above 70,000. But it still had, I think, its worst week, down about 15% on the week, despite the 10% rise today, the worst week since 2022. But the media wants you to think that this is a significant rally. Again, in a bear market, the biggest moves are up, the opposite of a bull market. Because if the bear market is sliding a slope of hope, today's rally gives people hope, false hope. People are relieved. Oh, I'm glad I didn't sell yesterday. I'm glad I held on. Look, we had this big rally. We're back. We're going to the moon, right? It gets you, helps you build a false sense of confidence. You're now hopeful that the worst is over. You rode it out. Now you just got to hodl. Well, the next thing you know, we're going to be making new lows. In fact, one of the interesting things about the Bitcoin decline is how orderly it's been. We haven't had any major, like 5 or 10 minute, 10% collapses, which have happened quite often with Bitcoin. You get one of these flash crashes. There's like a panic and there's a big drop. This has been a very orderly decline. I think where there might have been some panic was in silver. Silver prices, there was panic, not Bitcoin. And in fact, one of the reasons that I think that the price of silver was down so much yesterday, it was down, I don't know, like 20% in one day. There was no real news that would have affected it. What I think affected silver was margin calls in crypto. Now, there may have been some in silver as well, because some silver speculators who maybe put their positions on more recently got caught up. But I think that a lot of the margin players who own a lot of crypto-related assets also owned gold and silver-related assets as part of the dedollarization trade, right? A lot of people think that trade includes gold and silver and Bitcoin. Now, I don't think Bitcoin is part of that. Right? It's got nothing to do with it. It's a market unto itself. But the fact that people believe that means that there are a lot of traders out there that have positions in both assets. And if they had those positions on leverage and we had a 50% drop in Bitcoin and we also had a big drop in silver, right? It's likely that they had margin calls. And it's also likely that it was easier to dump their silver than their Bitcoin. Because I don't think that there was enough liquidity if they had bigger positions. Now, clearly, they moved the silver market by getting out of silver, but they would have moved the Bitcoin market even more. So I think there was some forced selling. And of course, you know, the traders can see that. They drop the bids. They know that there are sellers that have no choice, so they back away. And whoever sold out yesterday, because they had no choice, got a lousy price. And that's why I don't encourage any of my clients at my asset management company or my customers at Schiff Gold to go on margin. It's precisely because of days like yesterday where you have big drops and people don't have the staying power and they're forced to sell. And they turn a temporary paper loss that would ultimately be meaningless into an actual realized loss that means something. So I think that what happened today in Bitcoin is the dead cat bounce, is a bear market rally. Same thing with strategy stock, right? Strategy stock, as of yesterday, was down more than 80% from its peak price last year. 80%. Yet the stock was up 25% today, 25% gain in one day. But despite that 25% gain, it's still down 75% from its peak. So it barely moves the needle from down 80% to down 75%. But again, that's a bear market rally. Strategy is going lower. In fact, one of the biggest tells about what's going on there is their average cost on their Bitcoin. Their average cost is just over $76,000. And even though we had a 10% rally today, Bitcoin is barely above 70,000. So MicroStrategy is down on its Bitcoin that it's been buying over the last 5 years. Imagine if Strategy had bought gold or silver instead of Bitcoin, how much more the company would be worth, because they actually would have had a big gain on their investment. Instead, they lost on their investment.
The media continues to sensationalize the recent correction in precious metals, framing the drop in silver as a popped bubble to scare investors out of hard assets. However, this pullback has likely cleared the necessary sentiment for the next leg higher, with mining stocks poised to lead the recovery. Because the feared correction has already occurred, the overhang of potential downside risk is removed, creating a sustainable path for miners to reach new all-time highs, even before the physical metals do. This setup offers a strategic entry point for gold funds, as the sector begins a more sustainable ascent. In stark contrast, the crypto sector exhibits classic signs of a significant bear market, where sharp single-day rallies serve only as dead cat bounces to trap hopeful investors. Despite recent gains, Bitcoin remains significantly below its peaks and trades under the average acquisition cost of major corporate holders like MicroStrategy, meaning these entities are now underwater on their multi-year bets. While the silver sell-off was likely driven by forced margin liquidation from leveraged cross-asset traders, the structural weakness in digital assets suggests that the current slope of hope will ultimately lead to lower lows rather than a genuine recovery. Let's get back to the interview.
Kevin Walsh to be the new Fed chair and how he was portrayed deliberately by the administration and then the media as some kind of inflation hawk who's going to come in hot and hike rates or something or put an end to quantitative easing. That ain't going to happen, because if he was going to do that, he wouldn't have the job. It's obvious that he's got his marching orders and he is going to follow them. Trump would not have nominated him unless he was confident that he was going to do what is needed to try to make him look good in the midterms. In fact, he's already talking about mailing out these tariff rebate stimmy checks, $2,000 a family. You know, Donald Trump tries to claim that all this inflation is Biden's fault. The problem is, had Trump won and been reelected, it would have been the same. He says that the inflation is because of the deficit spending under Biden. Well, there would have been as much deficit spending under Trump. How do we know that? Well, he was a big deficit spender during his first term. Most of the inflation that we had in the first year and a half under Biden is because of the policies under Trump and the money printed while Trump was president. But what has Trump done so far in his second term? He has taken all the Biden deficits and made them bigger. He has spent more on all the programs that Biden was spending money on. He approved spending more on all those programs. So why should we think that had he been directly reelected, that somehow in that term he would have been for less government spending? He wouldn't have. All this inflation would have happened, even if Trump had won. And of course, that means we would have a Democrat in office right now, because the voters would have voted for a Democrat to solve the problems that they would have attributed to a Republican. So Trump is lucky, the Trump administration is lucky that they can keep blaming every problem on Biden. But the problem is they own the economy now, because Trump has already claimed that we have the greatest economy in the history of the world and has taken credit for doing that, which means voters will hold him responsible for the problem. I mentioned on, I think, my last podcast, you don't win elections in America nowadays by lying to the voters and trying to get them to believe that a weak economy is strong. The way you get elected in America is acknowledging that the economy is weak. And then you lie to the voters by saying that you're going to make it strong. And so the Democrats have got the better message in the midterms and in the generals. Anyway, that's it for this Friday market wrap. Again, I would recommend, as I've been doing on all these Friday market wraps, buy your gold and silver over the weekend. You know, we've had this big correction. We typically have rallies on Mondays. We've had a lot of noise recently, but I think we're going to get back to the same trajectory that we were on before, where we get strength coming out of Asia, because that's where the real buying was or has been, and I expect that to continue. So with silver prices still below $80, hard to imagine, I'm now saying that it's cheap to buy silver below 80, but it's been as high as 120. So seems pretty cheap, given that we now have a benchmark that's much higher. So we're buying silver below 80 and $5,000 gold. 5,000 is the new 4,000. 4,000 was the new 3,000, which was the new 2,000, right? The milestones keep moving up, but you got to keep paying up, because this is what happens when you're living in a world of inflation and de-dollarization. The longer you wait to get rid of your dollars, the less they're going to be worth, and the higher the price you're going to see for gold and silver.
The nomination of the new Federal Reserve Chair is a calculated political maneuver rather than a genuine pivot toward fiscal discipline. Despite being portrayed as a hawk, the appointee is expected to follow strict marching orders to stimulate the economy ahead of the midterms, ensuring that quantitative easing continues unabated. This is confirmed by the administration's push for new stimulus checks and expanded deficits, which mirrors the very spending policies previously blamed for the inflation crisis. The data indicate that excessive money printing is now a bipartisan feature of the system, guaranteeing that currency debasement will accelerate regardless of political rhetoric. This macroeconomic backdrop creates a compelling urgency to acquire hard assets during temporary market dips. With silver trading below $80 and gold cementing $5,000 as the new support level, the current correction represents a fleeting opportunity to enter before the next leg up. The rapid normalization of these high-price targets serves as undeniable proof of dedollarization. As the currency weakens, yesterday's ceiling becomes today's floor. Smart capital is using these weekend pullbacks to position for the resumption of the uptrend, recognizing that holding cash is a losing strategy in a permanent inflation environment. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.